Every NRI WhatsApp group has that one uncle. Beta, property is the only real investment. FDs are for scared people. And at that very same moment, your banking app is flashing 7% fixed deposit rates back in India. And your parents are nudging you to just buy something at home. If you are in the US with anywhere from 50 lakh to 5 crore rupees to put to work, this sounds familiar. You earn in dollars, you think in rupees, and everyone has an opinion about your money. So the goal is simple. We take one example, a 2.5 crore flat in Bangalore, and put it against the simplest alternative, the same money in fixed deposits. Then we open it into the three big waves and NRI plays Indian real estate. Traditional property with a few hacks, listed REITs in your DMAT and fractional ownership of grade A commercial buildings. By the end, you will know the returns, the taxes in plain English, the liquidity and the headache level of each. One quick but important note. This is not professional financial advice. Everyone's tax, goals and risk appetite are different. The point is not to tell you what to buy. It is to hand you a clear map. So when you decide or sit with your own advisor, you know exactly what game you're playing. This is NRI Lens, where we break down cross-border money in simple, practical language for NRIs. Let us start with the classic bar fight. Fixed deposit versus flat. You have 2.5 crore rupees, option A, fixed deposits at around 7%, about 17.5 lakhs a year. But after your NRE or NRO structure and tax, that is closer to mid-single digits, 5 to 7% in hand. The upside is zero drama, no tenants and no midnight calls. The downside is inflation and a weakening rupee. Option B, the same money buys a flat in Bangalore, renting for 65 to 75,000 a month. That looks like 4%, but the word that matters is net. After a vacant month, maintenance, repairs and brokers, you keep closer to 3. So FD at 5 to 7 in hand versus a flat at about 3 net, plus appreciation. And appreciation is where property seduces us. Parts of Bangalore have jumped 50 to 60% in a few years, which is why your uncle wins every wedding argument. But two things matter. Those are past numbers, not a promise. And when you sell, brokerage and capital gains tax turn a 60% headline into more like 45 in your pocket. So this was never safe versus risky. It is low return and low drama against a higher potential return that comes with tenants, paperwork and price cycles. Now, let us tilt the property game using India's own rule. Most NRIs do not pay in one shot. They take a home loan, which changes the math. Part of your EMI is funded by your tenant's rent. So you slowly turn the bank's money into your property. That is leverage. And it cuts both ways. On tax, a flat 30% of your rent is treated as an expense and is not taxed. And your home loan interest is deductible. With the old regime, still better for most NRI investors. There is also friction unique to you. Your tenant must deduct tax at source before paying rent, over 30% for NRIs. So on a 1 lakh rent, you might see only 69,000. The fix is to apply for a lower tax deduction certificate. This suits someone who wants a real home in India, is fine with paperwork and can hold 10 years or more. If that sounds exhausting, here is the good news. You can get Indian real estate exposure without ever buying a flat in your own name. That is a REIT, a real estate investment trust. Picture a a mutual fund that owns rent-earning buildings, office parks and malls instead of stocks. It collects the rent and passes most of it back as regular payouts. And you own units that trade on the exchange like any stock. So you buy through your broker, receive distributions that feel like rent, and watch the price move daily. In India, REITs throw off mid to high single-digit yields plus some price movement. The big wins are diversification. Your risk spread across many tenants and buildings and liquidity. Since you can sell in a few clicks, the trade-off, the price moves daily, and a 3% dip will rattle you more than an FD. Now, the newest option, fractional ownership. Picture a Grade A office building worth 100 crores, leased to a large company. A decade ago, that deal only went to ultra-rich families and institutions. Today, platforms slice it into pieces. So instead of 20 or 30 crore for the whole building, you take part with 10 to 25 lakh. You and other investors own the vehicle. The tenant pays rent, and your share of the net income and eventual upside flows to you. Compared with a flat, commercial pays higher yields, since corporate leases pay more and lock in longer. Compared with the REIT, it is more concentrated, one specific building, not a basket. The upside is access to assets that were HNI only, professional management and targeted returns, often quoted in the low teens. The downside is 3 layers of risk: property, tenant and platform, and you cannot just press sell. Your exit waits on a resale window or a final sale years out. So before any deal, ask 4 questions. What is the property? Who is the tenant? How do I get my money back? And what could go wrong? Now put all 4 side by side. FDs, flats, REITs and fractional deals. Use this as a self-diagnosis, not a ranking. Want predictability and zero headache? You drift to the FD end. Fine with more effort and uncertainty for higher returns? You move toward flats and fractional with REITs in the middle. Notice which column feels most like you right now. That is your starting point, not a generic best investments list. Because the real question was never which one is best. It is which one matches you. If you're 35, building your career in the US, and you hate the ideas of tenant calls, lean toward REITs and maybe one small, carefully chosen fractional deal, not a 2.5 crore flat sitting empty. If you know you want to move back and live in that house one day and you are fine with some drama, a leverage flat plus safer assets can make sense. If you are near retirement and mostly want capital safety and calm sleep, NRE fixed deposits plus a modest REIT allocation can beat chasing double-digit fractional returns. So, use this as a starting point. Do not copy your cousin's portfolio or your uncle's WhatsApp forwards. Weigh where you are in life, your risk tolerance, your time, and the admin you can stomach. Then sit with a qualified advisor who understands both the Indian and the US rules. That was your real estate masterclass from NRI Lens. See you in the next one.